Okay, good evening, everybody. It's Ken of Tortoise Capital with a nightly strategy report and podcast for May 5th, 2020. So a lot to cover tonight, so we'll just jump right in. Okay, so we're looking at a 10-day look back on the market right now, and we've got the 10-day high, the 10-day look back period, and then the 10-day low. Tomorrow's 10-day low is going to jump up one level here. It's almost like a triple bottom there at about 278 and a half. So that will be tomorrow's 10-day low once we get going. Today we had a gap up to the edge of the dragon, sold off a little bit, gained a little bit up to the previous peak of the RL10, and then rolled back to close marginally. Now, this felt like a weak day. I know that it was up day over day, and it broke out of the dragon, and the dragon is now sloping up. And it just came into the edge of the dragon, and the dragon is on the edge of the river, and the river is sloping up. But it just felt like today could not get traction. Like it had a nice gap up, and then it just didn't have much traction at all. Early weakness and some grinding the rest of the day. So when we get to the speed run, what we're going to see is that it felt disappointing, and so I was cashing most of the swing trades that I started yesterday that were in their second day of gains, and especially if there was a clear win in hand. I didn't let that come back under the gap up in most cases. So when we get there, that was kind of the deal. So that's what it felt like today to me, was a gap up, and then it couldn't finish, and then it closed lower. And so in most cases where I had a swing trade that was started with yesterday's turbo trades, and then we kept a piece, and then it gapped up and then made highs, and then they started failing backwards. In most cases, I was just taking it where it gapped. Like I gave it that much room to run, and it couldn't hold, and so I decided to trim a lot of those positions. Having said that, it's still technically an up day, and it made an effort to move back towards that 10-day high, and it did test the RL10 hump for a moment. And the slope of the dragon extension is positive, and price is right in the middle of this triangle that's formed by the decaying RL30 and the rising PSAR. And so we're kind of like right in the middle of this indecision zone as it tries to make new highs. And so, if anything, this feels more like what the market should feel like at this time. That it's, 3 steps forward, 2 steps back, or 2 steps forward, 3 steps back, kind of that grinding play. It should feel like this. The earlier buy anything on sale with lots of Fed money seems to have run its course, and now we're starting to see differentiations between winners and losers in many different sectors. Companies starting to file for bankruptcy, more details on unemployment, grinding news coming out of the management of the virus, a number of states trying to get people back to work, and it feels like they're almost giving up on destruction of the virus or prevention of the virus. There's almost a whiff of desperation in the air in that sense of getting things open, and with lack of leadership isn't helping that at all. And the alternative is worse, if anything. So there we are. So this is an aging third leg up. So what we've seen in this third leg so far was an initial gain, gave back most of it, and now it's trying for this next second run up at the 10-day high. On the way up, we're looking at the triggers to the upside would be the high of the day, at 289.30. The hump of the RL10 at 289.66. Next one would be the 10-day high and the 30-day high, which is up here at 290, basically 295. And I would say also, if it can get through this RL30 extension, that looks like about 293-ish, then that would be another favorable sign. On the downside, the weakness, I'm concerned about those. We're looking at low of the day here, about 283.5. Skin of the dragon at about 283. PSAR at 281.25. What's going to be the 10-day low around 279. And then, the current 10-day low 277-ish, but I would really take the dotted line as the support level. And then it's all the way back to the Bollinger Band mean at 272. So a long way to fall. So that's a look at the tactical context. I view this really as right at the midpoint of a compressing 10-day range. So that 10-day range is getting smaller. It means time is running out. You can actually see the river actually started to roll over today too. So you got three little indicators that the longer term time frame is starting to run out of gas. So this indecision pocket is getting smaller and smaller before we're going to break to the upside or break down. To me, it feels like the breakdown is the more realistic and probable. I don't know what the percentages on that would be. But that's the bigger concern for me, is making sure I don't get hit with that rather than feeling like I'm going to miss some kind of upside gains. We can see that the RL270 long-term fair value has come back. It's now under 300 at about 299.7. Quick review of the winners and losers today. Excuse me. So let's take a look at what won and lost. And even though it felt like a disappointing day, I mean, the S&P was up 0.9. And what was better? Japan marginally, silver and Mexico both better. Technology leaders started to lead more today. So XLK, Apple, had some metals at Cliff Natural Resources, healthcare, wheat and precious metals, and oil itself. Invariably, somebody calls me at this time. Couldn't do it better if I planned it. What was worse than the S&P? Tesla, Walmart, small caps, the Dow. So even some of the speculators were giving up a little earlier today than usual. Real estate, Cisco, Materials, EuroAsia, Alcoa, Energy, Amazon. Just now we're into the red with finance. Treasuries, oddly, continued to be weak. McDonald's, lumber, oil exploration. So we're getting into some real negative territory. So that was kind of the feeling that I was getting from today, was that it was maybe the market trying to gain traction and try to hold on, but there were no real clear runaway winners and no compelling narratives of who the movers were. It just felt like heavy sledding all day. And that was part of the that lack of enthusiasm was another reason to take a bird in the hand instead of two in the bush. Big losers in today in U.S. Steel gave back yesterday's gains. Devon Energy couldn't hold the gap up. Boeing and Simon Property Group, not good either. Let me get a cup of coffee. Pardon me. This is all okay. Yeah, so this was not a day for enthusiasm and taking much risk at all in the overnight. You can still see everything in the fall. Still lots of blues in the daily fall column for Four Seasons. So that is, again, indicative of an aging market. And unless it's really showing strength, there's no compelling reason to hold lots of overnight and swing risk, particularly with the risk Z having rolled over, and then the 10 and the 30 regression lines rolling over. The river's starting to stall as well. All right, let's see. I want to see if the speed run's going to cooperate. I'd like to go through that first, just to get a sense of where things were and some of the operational decisions that we made today. So, Apple Alcoa stalking. It's holding steady, but in a sideways pattern at the edge of the river, and the PSAR is still relentless about marching up. It couldn't really hold the gains today. Came back below the RL10 and closed at the edge of the river. So that's in a holding pattern. Apple. Oh, man. All right, charts are delayed again from TC2000. I think that's more my my connection than their problem. So I will finish recording the speed run as a separate video and hang that on the website so you can see it uninterrupted. Sorry about that. We're going to jump straight to the review of the daily report. So one of the things that we'll notice now is that when the market itself starts stalling out, you're going to start seeing more and more symbols taking on their own leadership qualities. So we can start seeing some differentiation now. God dang it! Come on. God, I look like a drunk. There we go. So into the daily report, we've already hit the health check. Oh, I should also notice that we are still well into the fall on that MACD histogram. Let me let that come up on your chart there, on your screens. So yeah, the MACD histogram is now about 4 days into the fall, and so it's running out of time here to make that next leg up. And then the default position is that when we're in bearish normal conditions like we are, then we're more concerned about the downside than we are missing the upside opportunities. So that top level look, reading from upper left. So we're still in bearish normal conditions. Under these conditions, it's a bird in the hand is worth two in the bush. So that really drove my decision making to cash swings today. Everything is back in the neutral zone there on the NDXs, except for the 30-day look back. There's still the residual overbought. So it still feels like we've put the pain behind us, but this lack of follow through these last 10 days is starting to undercut some of that earlier enthusiasm from all the Fed pumping. You know, there's some more difficult questions being asked. How much more pumping is there? Where's that money's going to come from? There's still a lot of important social priorities unfunded, and so where the line's going to get drawn is now going to be influencing the political rhetoric as we go into the elections. And so that's not a recipe for national support and national cooperation. So if anything, it's going to get more and more bitter. This will, if you thought last election was horrible on a social level, this one is going to really eclipse that. We are in yellow bearish on the market mosaic on the right-hand side. So it's at minus 4.57. That means we're 2.5% below the boundary for the sideways market. So that's still bearish. But the fact that it's yellow and it used to be red means that we've actually climbed quite a distance out of the hole. Eugene asked me, does the Red River relate the position of the dragon to the river in the main graph? That is a 30-period Bollinger Band on the MACD histogram line itself. And so what that is really doing is giving us indirectly, the answer to that is yes, but it's not as straightforward as you might suspect, because the MACD histogram is using a comparison of the 10-period simple moving average, the spine of the dragon, and the 30-period moving average, the middle of the river. But it's comparing the gaps between those two, and it's a 5-period smoothed average. So that Z-score is the Red River gives us the picture, the snapshot of the Z-score between plus and minus 1. So it gives us a visual on that relationship. And so it's derivative of the dragon and river, but it's not it's not a snapshot of it, right? What it does is it gives us a sense of how extreme that the dragon pulled away from the middle of the river. So it gives us a sense of the relative magnitude of the move of the last 10 periods. So to answer that question. So yellow bearish then in this price relative to the 200 says that although we are bearish, we're starting to get closer to the sideways zone. ADX is still a non-trending 19.3, so the this stalling is now starting to affect the measured trendiness. ATR percentage, the relative volatility is back into normal at 2.26. It's down from 2.74, so it's getting quieter, and that lack of volatility is associated with a market that is trying to sort itself out. It feels comfortable at this pricing level, and now it's really a search for who the winners and losers are for the next leg. So this is a differentiating market. So we should start to see more signals coming up for individual companies in narrowly defined sectors, and that's actually what we're seeing. The risk index is the 30-period moving average of the VIX divided by the 10. 1.0 is the boundary between risk on and risk off. It reads 1.25. So we are well into risk on. So there are still favorable conditions to hold some of the riskier assets, like a Tesla or a Twitter or an Apple, as opposed to conservative assets. We take that score of 1.25 and look at the last 5,000 trading days, and then compute the standard deviation and the Z-score. And the Z-score for that reading is 2.27. So below that, you see a 180-day time series of those Z-scores. And what I want you to notice is the magnitude of that sell-off over the last 40 days that took us, minus 40%, ended up giving us a Z-score of minus 4 at the peak. When that rolled over and then started marching back towards zero, that was an indication of improved opportunities for swing trading, which we were able to take advantage of. That decline in that volatility is the first tell that the market may have bottomed and is working. So we're still working on that assumption and trading that way, and so far so good. When it comes through the up to the zero line, it's in the spring. When it crosses over the zero line, it's in the fall, just like we interpret with the MACD histogram and the slope statistic of the RL30s. And it's in the summertime. That's when we're making hay. That's like the second leg up in the market was pretty strong. And so there were some good swings and some directional moves, while there's still a lot of volatility and some strong directional movement. So what we're seeing now is that it has kind of flattened out at right around 2. And now there's a little bit more volatility creeping back into this market. This is vulnerable to sharp moves in either direction, particularly because the daily ranges have been relatively small. No signals in channeling and overreaction. Channeling won't fire at all until we get back up into the bull market. So that's where that market, it only has a couple, 3 rules, but that includes at rule 1 that market filtering function, which protects you when times are crazy like they are now. 10-day min pain and max pain. This is price with respect to the 10-day high. The min pains are the ones that have lost the least percentage from their 10-day high, and that has relative strength leaders like Home Depot, Microsoft, United Health, Pfizer, and Visa, and Apple. And the 10-day max pain are the ones that have lost the most from their 10-day high: Boeing, Disney, American Express, Caterpillar, and 3M. So I tend to be more of a bottom feeder, and I look for things that have suffered an excess of fear and suffering and have started to rebound like a second mouse. So that's typically where I spend my time on that part of the curve. Tactical summary: there's quite a few symbols now have auto framed out at better than 2 to 1. And you can see the top 5 in the max pain range compression: Boeing, Walmart, Travelers, Intel, and McDonald's. Travelers and Intel are of interest to me. Boeing, actually all of them really are. McDonald's has been strong, but closed with a RSI2 value of 4. So that means it's had a very rough 2 days. And it's a percent loser in the Dow over the 1-day and 10-day look back period. Those two performances are highlighted red. That means relative to the Dow, they are more than one standard deviation below average of the components of the Dow. So when you see those red shaded boxes, that performance is bad compared to the peer group of the Dow 30. And similarly, the green boxes are ones where that symbol has been significantly outperforming the Dow components as an aggregate. There were 3 symbols that broke out to the upside: Microsoft, Apple, and Home Depot. No surprise there that they have been relative strength leaders the whole way through. And I'm really impressed with how Microsoft has just quietly rebuilt their entire brand. They got some good leadership in there and a good business plan, and they're getting it sorted out. And Apple seems to have weathered the storm as good as anybody. So they're on my short list. Now, in the auto framer, you see there's a whole stack of recognizable names that test out very well, better than 2 to 1 on a auto framer basis, meaning that they're if you use today's risk as their or today's range as the risk, then that's the multiple of how many of today's ranges is it back to the 10-day high. So something like Caterpillar is offering a 4 to 1 reward to risk ratio. There's a lot of 551Ws in there today. Now, for a 551W, what you have to see is it's up over 5 weeks. It's lower than it was 5 days ago, and today is a white candle. So while the market itself closed lower than it opened, like it couldn't hold that gap up, everything that's fired on a 551W put in a positive day today where it actually closed higher than it opened. So those would be on a relative basis attractive. So Walmart is interesting. It's a 551W. It's number 2 on the max pain range compression. It's also a doji. And on a 3-month and 12-month basis, it's been performing very well compared to the peer group. So um, we saw last week Walmart had been lagging everybody, and now it just feels like they have got some traction underneath them. So I'll be framing them tonight to keep going. And Eugene had a nice couple trades on the Walmart intraday, which we'll take a look at when we get to that part of the brief. Okay. Also, 4 or 5 day downs worth looking at. McDonald's is interesting on a 5DD. Now, I love the 5DD, and if you look in on the Patreon site there, subscribers, you'll have the example system definition of 5DD as I posted last week. It is, I think, a very good example of how to develop a systems definition. It includes not only all the rules and the setups and the justification and the backtesting results and the forward trading insights, but it also gives a set of possible extensions and stretches. So if you're looking to modify or extend or leverage the rule sets, then there are some natural places to look on the basis of us having traded it for the last 20 years. So McDonald's 5 day down, Disney 5 day down, 3M and JP Morgan 5 days down. And so all of those are very interesting to me on that basis. Time permitting, maybe we can try to frame some of those. I'm going to write those down. Make sure I get to them. So that's McDonald's, Disney, 3M, JP Morgan. Okay. In the ETFs, we have, again, almost the same kind of patterns. We have a lot of things that test out well on the auto framer. The only thing that broke down to a new 10-day low, though, was treasuries. That's kind of the anomaly to me. I would think, my spider sense would be that, if equities are stalling, that treasuries should do better, but that's not the way it's being played right now. And they're offering a 4-to-1 reward to risk ratio, and they fired on a channeling pattern. So I wonder if we could look at that, if the chart would cooperate. Sure would. So here's this is what a channeling pattern looks like. We have something that's clearly in a long-term bullish move. It's above its 200 period moving average. And it's had a measured pullback to oversold conditions using the NDX10. And I like that it closed with a slight upward bias today. So if we looked at it on a 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, here's that 10-day look back would look like. You can see it's in the bottom of the 10-day range. And what I especially like is that it actually closed higher than it opened. So this is one where I would automatically buy it on a this is what the mechanical entry in treasuries looks like. Okay. So I'm going to put that little trade bracket on it. I'd like to see it open inside the darker yellow box, and then I would add, and then I would enter long here. I would enter long anywhere that, even if it gaps up, as long as it was, up to, but not beyond the Bollinger Band mean. So I would automatically go there. I'm going to start this as a hybrid frog tomorrow, and then try to make some money intraday on it in order to get paid, in order to carry the swing trade overnight. So treasuries will be a high priority. Now, because it's a 5-day down and we're in bare normal conditions, if this thing opened and then fell through the low, in other words, was on its way to becoming a 6-day down, I would also use that as I would start it with a hybrid frog short and then try to keep a piece overnight if it was going to close below today's close. So if it looks like it's going to be a 6-day down, then that's a swing position that I would maintain. So that's what a 5DD mechanical system looks like with a mechanical frame. Now that I'm gonna engineer this a little bit. If it opens inside that yellow box and I take this mechanical entry, I'd be looking to add a second one if it breaks above the Bollinger Band main, and then if it breaks above the skin of the dragon, and then above the hump of the dragon, and all the way up to the peak of the RL10. So those are pretty stable price levels. We can just leave those on there. On the way down, if I get short if it broke through the low of the day, I'd come over here to this belly of the RL10 and add a second position there, and that would probably be enough unless it were to fall through the floodplain at Z-2. So that's going to be my trade frame tomorrow, and I'm going to start them with the hybrid frog, and that's treasuries. Okay, so that's the 5DD typical trade frame for a mechanical system. So well done. Okay, now back to our regularly scheduled program. So the other things of interest on the ETF 30 tactical summary. An unusual behavior in the energy sector. So USO oil was up reasonably today, 9%. I think the bottom's in. And then XOP, the oil exploration, got crushed at minus 1.5%. So very liquid and tradable and directional. So yeah, that's the tactical summary. So lots and lots of favored symbols to choose from. You got some dojis, you got a channeling to look at there in treasuries as well. Daily pinch and stretch report. Again, this is really just placing things in their life cycle. So you can see the extreme performers in terms of positive and negative Z stretches based on their Z score for the first two sets. And then the most expanded pinch box is the one that's going to give you the biggest directional move so far, like over the last 30 days, is going to produce that. So that's why oil is at the top of that list. That's been the most directional move. And then XLV has been very strong. The 30-day moves in the S&P, the Russell, and the diamonds. So that's the U.S. I put the U.S. stats in all of those. They're kind of in the that negative yellow zone, minus 0.05, meaning that it's basically just made an average width of the river. Okay, so they're that volatility has really calmed down in the broad markets. It's basically back to normal and actually starting to get a little bit narrow. That wouldn't jive with your intuition, would it? It doesn't with mine, but that's actually the condition that it's in. Damn charts, not showing. The compressed pinch boxes are the ones that are exceptionally sideways over the last 30 days. So you can see some things that are starting to compress into what could be a nice sideways quiet channel as long as that river keeps compressing. Next up is the auto framer. So the auto framer has quite a few, has about 15 or almost 20 symbols on there, and these are ones that all test out very well on the using the 10-day high as the target, and then using usually today's range as the risk. So Goldman Sachs, Johnson & Johnson, Walmart are all in that category near the top. Lots to choose from. It has all the mechanical framing data if you're building your charts. The RLFF, the regression line fractals, that's finding the winners and losers with respect to fair value. So the top shelf in the green are the deeply discounted ones, they've sold off the most from their long-term fair value. So things like these are all the relative strength losers like Boeing, Coke, Morgan, oil, Brazil. Bottom shelf in the red, these are the ones that are overheated. The most numbers of ATRs above their long-term fair value. So the gold miners, almost 3 ATRs above fair value. Treasuries, oil exploration has been very strong too. So these are the ones that you'll find are relative strength leaders. Under the stocks, you'll see Pfizer, U.S. Steel, Microsoft, and Cisco. So U.S. Steel has been acting more like a tech leader than a steel maker. Next up is the daily squeezes. A lot of things on the squeeze here, and that's a reflection of just how narrow the ranges have been getting in this market. Oil, surprisingly pinched on a daily basis, and it looks like most of that movement it's had lately is coming from the gaps rather than the intraday moves. Makes it difficult to trade that one intraday and unpredictable for swing trading. So that's why I've been really steering clear of it. But some good names on there to consider. Treasuries, there's another good reason at 3.1 on the pinch and stretch, that compression, that daily squeeze. If that thing does break out of that channeling, that tight range that we just went and looked at, then that one can really move on a single day. I would especially look to watch what it's doing if there was a sell-off in the S&P. But you'll notice even at the bottom of the list, Microsoft, the S&P tech leaders are on that list too, so they're all poised for a breakout. So this is more of like a market condition. This is, I think, everybody sharpening their knives and really trying to find who the leaders are and trying to find the differentiation among leaders as opposed to like market fear itself. So that's what I'm seeing. Most everything's still in the fall. At this point, the ones that are in the summer are the ones where I'm really going to be paying some attention. So Mexico, energy, technology, metals and mining still in the summer and looking strong. U.S. Steel, Home Depot, Apple, Dow Chemical, looking strong still. So all other things being equal, that's what I would be looking at. NDX time frame, a couple things really leap out. You can notice under the Dow just how strong Home Depot and Microsoft have been. They broke out of their 3-day, 10-day, and 30-day look-back periods, and they've been above average strong the whole year. So look at the strength in Apple and Microsoft, but especially Microsoft has been a clear leader for the past year. Under the ETFs, only treasuries suffered today. Lots of breakouts from their 3-day look-back period. Oil is still charging along, and Mexico and the tech leaders and XLK really are getting my attention right now. Lack of volatility there in the 30-day regression line for the market mosaic is the next chart up, upper left-hand corner. See just how unvolatile this market has now become now that it's climbed out of that hole. And I want you to notice in chart 3 below that the slope statistic, the RL30 slope, which had been marching along pretty nicely and got up almost to 2 sigma, has now rolled over and crossed over its own 10-period average, more than 1 standard deviation away from the long-term average. That has always been a warning sign for potential turning points. So this failure to follow through is starting to become troublesome. You can see that in chart 2, and you can see even in chart 1 that the parabolic or the polynomial regression line has rolled under the straight line regression, and that's sort of a front runner of increasing weakness short term. The percent stretch compared to the 200 has kind of settled in at that support level at 1 sigma. It's climbed out of the basement, but this is really a market that has to prove itself. We've averted a disaster, but there's no compelling reason why equities ought to continue to gain, except if you believe in unlimited Fed pumping. But they're already starting to talk about, putting the brakes on that and pretending that the national debt means something. That's everything I want to cover from the daily report. The rest are kind of derivative and much deeper details. I want to shift, let's see, let's take a look at some chart recaps right now. So here's one on Devon Energy. I wanted to get started this morning. I'm going to go through these pretty quickly now. Respect your time because you got more prep to do tonight. Devon Energy gapped up and the energy sector was strong. So about 5, 10, 15 minutes in, I've noticed it's got this, that peak of the RL10 up in here. Peak RL10 here, belly of the RL10 here, so that I create my little wrist box, my managerial wrist box, if you will. And now we're about 30 minutes in. It has started to compress. So now it's made it made this low, and now this high only got back to the VWAP and started to roll over. So that little compression intraday now feels like it's gathering strength for a storm. It breaks down out of that channel to a new low of the day. So I'm short at the red dot. I put my stop right at the green line at the hump of the dragon. I'm aiming for a move back down to yesterday's VWAP, or at least yesterday's close. So I'm looking for this price level. Comes down to yesterday's Z3 excursion. And this was also the high of the day yesterday. That blue line carried over. And so that just felt like getting paid early. Didn't feel like a runaway move. And oil was going up towards a 9% gain for the day. So it just felt like time to take. I tried a reversal to the long side. This thing shortly failed and basically scratched that trade. But that's kind of how I get started. And I like to get paid early just to ring the bell and get warmed up, if you will. The next one I just want to show is the continuation plays in Devon. So this is where this one was a dogfight for me this morning. Right? So we had this is the one where I got short, tried long, fractional loss, got short. In the construction of this chart, it ended up stopping for a fractional gain to offset that fractional loss and getting long. And then we put another fractional win inside here, and it started feeling like a dogfight. So there wasn't much traction in that. I wanted to let's see. This was one from Gerald was working on EWZ Brazil, and so there were a couple coaching points that I wanted to make on this one. I thought he did a really nice job. First, let me just talk about the life cycle of his trades, what he did, and then I'm going to come back and talk about the things that I want him to look at and you. So the first thing he noted, he drew his yellow box as the frog box, and he noted that he missed the hybrid frog. I like that he didn't chase. He let this become an owl, so you have an unambiguous move, particularly when you add in the gap. Unambiguous move, P1, RLXD, dragon rolls over, RL30 rolls over. This is one of those where it rolled over so sharply that the RL30 actually turned before the dragon did. And he buys the PSAR flip. Perfect short. Perfect. You could even consider a second short here when it breaks down below the belly of this, and that would be a collapsing dragon second position. The justification would be you're in the money. It's crossed the VWAP. The VWAP is rolling over, and the rebound was hardly anything. The 10 couldn't even get through the dragon, and you have a collapsing dragon. So there's a lot of good reasons to get short there. Plus, you're getting ready to cross the fair value to the downside. So this is a potential short second position. Let's see. He covered right here. That was well done. It goes into a sideways quiet channel. He gets short here. Fractional loss here, gets long after a double bottom and like a pocket continuation, almost basically an owl, because you treat this as an unambiguous move. P1 happens over here. RLXD, dragon is rolled up, the 30 has rolled up. I would count that as an owl or a maybe a P4. So that's not bad. And then he's not going to lose money on that trade. So he noted that his collapsing dragons, his entry here and here. Oh, I missed this one. I'm sorry. These collapsing dragons were late. Yeah, this one is almost it's getting below this one. I think where you want to be is at 6 and 7 in the elbow of this dragon. And I'm going to talk about that again in a minute. So the closer you can get into that little nestled bend, the inside curve of the dragon on a long or on a short, the better, the closer to the RLXT, I think, the better off you are. I don't think those are bad entries. Those are reasonable, and I like the exits. In fact, this one might have come a little bit earlier, like right in here instead of here, like at the PSAR flip. But it didn't cost you anything. So the things that I want to look at then, some additional markups. I thought he did a nice job naming and explaining and demonstrating the ideas. I just want to spend time on this one. And I want to talk about getting an earlier entry than the hybrid frog entry up in here. I want you to notice that there was a big gap up above yesterday's Z3. So it gapped up to here and makes a strong move 1, halfway pullback 2, which finds support at the skin of the dragon. So 1, 2, a higher low when it turns at 3. Now I think you can buy this as an emerging dragon at 4 instead of waiting for this. You can get this here with a stop at the PSAR. And I really like that because that minimizes the size of the box. Instead of a hybrid frog box at 0.7, this is probably half of that. And yet you have a very manageable trade. And you can see you'd be in this. By the time you would get to the hybrid frog entry, you're already in the money and probably moving your stop to no lose plus dinner for 2. You're probably taking that stop and moving it up in here. So now you've locked in a gain and your risk is out of the market. I want you just to notice the thing to look at over here on 5 to 6. Whoops. The thing to notice on 5 to 6 is the belly of the RL10, belly of the RL10, and then you get that collapsing dragon at 6 instead of down here. Would have been a little better. The other thing I want you to notice is as you just start watching the high in the RL10 and a lower high, the high in the hump of the dragon and a lower high, so you get this downward pressure. If you connected this, especially coming out of this sideways pinch, the Z3 pinch, and this thing is voting down. And at the same time, you have the belly of the dragon and the belly of the dragon. So you have this downward channel between these two red lines. That gets broken at 8 when you actually have a double bottom now in the bellies of the dragon. And at 8, this takes out the hump of the dragon. So 8 nestled right in here, it feels very strong to me. And now you've had a PSAR flip, and now it makes this move up. And now this RL10 is higher than that RL10. So now it feels like you have an upward channel. So I want you to feel how that that price is turning, that failure to fail further. If it was going to fail and continue like it started off, then this channel would have continued to come down here like this, but it didn't. It PSAR flipped and then took out this previous hump, and now it feels like it's up. Okay, so that's that one. This was Simon Property Group. My ill feelings on that one did me well today. You've seen me trading it on the long side on swings because of price reasons, but today it gapped up. Let me let that come up on your screen. So Simon Property Group gapped up. I draw my little box from like the peak of the VWAP to the belly of the RL10 to the peak of the RL10. Then when it collapses out of that box, which is not a big box, if we went over and looked at that price action, you know, that's about 65 and a quarter to 64 and a quarter. So that's like $1. So when it falls out of that box, it makes a collapsing dragon short, second position short, and scratch that one, and the whole thing is all out. And so we're out of that at 62.50. So we're short at like 64.50 on $1 risk and covered everything at 62.50. So that's 2 execution Rs. Tried a second dragon down, quick scratch, fractional loss. It gets up almost to the VWAP, but can't break through and starts to roll over. Has a Z3 pinch and then breaks down. So I just try it short and it pays. So probably another execution arc because we're short at 63 and a quarter, covering at 62 and a quarter. So another R. So that's 3 execution Rs on SPG right there. I want to show. Eugene had a nice one on Walmart, and it illustrated what I thought was a nice point, and that is I want you to just notice the yin-yang effect of the dragon, right? So notice that the river is kind of slowly, it went up a leg, flat, up a leg, but notice that the dragon puts in 3 really nice, defined, distinct legs with clear turning points. It moves up, rolls over, comes all the way back down to the edge of the river, reverses sharply, nicely, and works all the way back up and starts to stall exactly at the last place it started to stall. And the RL10 and the dragon give us that statistical turning point, and that becomes a very nice way to estimate the length of the next leg. So if this thing were to roll over and fail, it wouldn't surprise me if it came back to like 123.80, which is the previous belly of the dragon. So this dragon, as it oscillates very smoothly, kind of confirms the oscillation in the RL10. RL10 is a little bit noisier, but it has clear and distinct turning points. And so those two taken together give us a very nice set of tradable behaviors. So this is a nice move up, a nice move down, a nice move up. Eugene talked about how he was managing the stops here using the looks like either the PSAR or the belly of I think it's the southern skin of the dragon all the way up to really lock in the position. So nicely done. Good job on the trade management and clear intention. Yeah, I like. He's got the OR5 kind of mapped out, and then an entry right about where the cursor is over here, about 123.90 would be nice. And then you can get both. You can get all three of those legs. So well played. Um, yeah, let's. We're going to shift now to the conceptual piece. I'm going to give the speed run one more chance because it's the charts are trying to populate. Let's see if it'll cooperate. Yes, so far so good. So Alcoa, we're just stalking. Apple, we got long today, so it's a tech leader. It had it's well above the river. The dragon's stretching up, so I kept the piece here at the. I traded it intraday and kept the piece basically from the open, and I'm using the PSAR as my execution risk. Day one of that swing trade, I'll add a position if it gets through. Through the fair value up in here. So the long-term target for that is going to be, it's well on the way to recovering its gains up here around 323. So you still got $50 or $40, I guess. That's about another 15% upside to it to be fully recovered. Amazon, this was problematic today. Amazon, we had looked at this sideways chop when it was back inside the river and had fallen through the dragon. The RL10 had fallen and fallen. Today was a micro gap up and then couldn't hold it. Now it's back in the river and south of the dragon. That is not evidence of leadership. Aussie dollar, just studying, just stalking, couldn't really break out of the river. It's almost getting ready for a turning movement. I'm stalking Boeing on this sideways and it's failing. I'd much rather go short than long. Caterpillar at the bottom of the river, finding some support. Oh boy. If this wasn't a bear market, I'd probably be ready to go long on a breakout of today's high. But I want to see it intraday first and then maybe keep a piece if the whole market is strong. But the fact that it's bear normal now and a stale market, I didn't hold. Cliffs Natural Resources. This was one where the metals started off pretty well today, so I got long here, and I was holding it. I was intended to turn it into a swing, but then it started failing, and the rest of the market just sucked. So I decided to exit the swing with that little fractional gain. So I gave back that much because I wanted to give it a chance, but it just this was not something I wanted to hold overnight. Cisco, same thing. Yesterday we got long on this one from here, held it overnight, and then it gapped up nicely, moved up smartly, but then as it started failing in the afternoon, I just took the exit before it got to the open and cashed a 2-day swing. So from green line to that second red line is the capture. Lumber, just stalking, it's weakening. Chevron, got long yesterday. It gapped up nicely today, but as it started to sell off, I just cashed a 2-day swing. I wanted to preserve gains. The Dow 30 held support yesterday, as we talked about in the podcast, and gapped up, but really couldn't hold it, and is still stuck in the middle of the dragon in no man's land. Devon Energy, stalking. Emerging markets, stalking strong. It's, I think, a little better than EFA, just stalking. Japan, stalking. Mexico, a perfect example of that swing trading one day at a time and then harvesting them when you can. This one is, so yesterday it started off as that intraday hybrid frog, and it performed so well that we kept the piece from our initial batch, and using the yesterday's low as my stop and below the Bollinger Band mean. Today was a big gap up. It moved up nicely, and as it came through back through the open, just cashed a 2-day nice move. So the R capture there is from green line to red line against a risk of green to red. So that's probably 1, 2, 3, 4, maybe 5 R capture. Brazil, stalking, not as strong as Mexico. So that's an example of that differentiation in Western Hemisphere. Facebook, I just don't like them. That's one of the companies I still have a irrational psychological block against. I'm trying to get over it by just studying the charts. But tech leader that actually gained somewhat today. Gilead Sciences was disappointing, couldn't hold. It's in a doji below the dragon. This is one I'm ready to short. And I would start that intraday. Google, it was okay, about like Facebook, nothing to write home about. Home Depot closed well. This is one I couldn't pull the trigger on because of bear normal and the general malaise in the market. I couldn't find a reason to get in and stay in. The Russell had again, much like the rest of the market, disappointing bounce and closed back at the edge of the river. No reason to hold it overnight. Just studying real estate, couldn't muster the enthusiasm to go long. I think I would go short on a breakdown below its low of the day. So I think I would be looking. Yeah, that's what I would do. McDonald's, disappointing day. I was close to getting short, but I don't want to short such an icon. But tomorrow I will get short at a low of the day, and I would turn that into a swing trade short. It's clearly voted down, and that would be an owl. I would treat that as an owl entry on the short side tomorrow. Nucor Steel, stalking. Clean Energy, just stalking. Let's go to Spice, Virgin Galactic. Got short today. It couldn't break through the dragon. Even though it was a gap up, it was still below the dragon. Briefly flirted to the upside and then collapsed down through, so I got short. I kept the wider stop. I'm going to let this try to unfold for a while. I will add a second position there, a third position there, probably a fourth one here. Yeah. Simon Property Group. We got short on that one today here. And it closed weekly. That's good. I've still got my stop up here. I think I'm going to put that in as that's a hard stop. My signal would be here, I think, I'm going to defend the north skin of the dragon to keep, to try to keep something out of that trade. But you can see where I will add 1, 2, and 3 positions. Treasuries, we've already talked about. Tesla, tech leader, had a nice bit of a rebound, almost a 1, 2, 3 entry. I think I could get long tomorrow. Twitter, not as impressive as the other tech leaders. Run down to Walmart. Walmart, I kept the piece, got long today when it crossed the RL 270. I'm looking to add a position above the daily high. Stop is right here. I think I will add another position if it gets above the dragon. Wheaton, got long today on the 30-day breakout. And then a wide stop below the skin of the dragon. Got to follow the rules. Win, just stalking. U.S. Steel. This is another one of those 2-day trade frames. So the metals were really strong yesterday. And so we had kept the piece. And it gapped up strongly. And then hit Z3. Got even a little past Z3. And then started failing back into the range. And I said enough was enough. And I want to get a nice capture. So that's like 2 sequences in a row where like a 2 to 3 day trade has really paid off well and protected us against downside. Among the XL series, basic materials are looking pretty good. North skin of the river, above the PSAR. Energy is better than that, though, although it closed poorly. Finance is lagging in the middle of the river at the Bollinger Band mean and failing. Technology, probably as strong as materials. Healthcare, love them to death. I'm ready to get long on that tomorrow on a 1, 2, 3. And then finally, just notice how volatile that XOP really is. It closed poorly today. It's still in that normal range along that blue regression line. So this was not an unusual move, even though it was down a couple percent, and the daily range was about 5%. That's just how that thing trades, and it's one of the strongest symbols. Its RL30 slope is just extremely strong right now. Okay, so that is that. Thanks for hanging in there. I got about 20 minutes of material on some flashcards to kind of fill in the gaps right now. So let's see. I want to cover this one. Yeah. So time, will, pattern, and money, just some top level things. Take a look at how you are chunking time. Self-assess. What are the time frames that matter to you? I look at, intraday, daily, and weekly. Look at how you are using indicators to start anticipating potential behavior. I want you to think about how I use those extensions of the RL30 and the PSAR and the Dragon to start anticipating where price has to start making a decisive move as it's running out of time. I'm trying to project forward what the future might look like if nothing changes, or what's the trigger that tells me something changes. I want you to remember, in terms of time, that like in a judo fight or a boxing match, there's a time in the fight when both guys think they're losing. And the guy that keeps going and sticks to his plan and adds gas will often win. So stick to the plan. It should feel a little uncomfortable because you entered during critical states when there's a strong emotional argument on both sides that that there's a good trade in either direction. The importance of the multiple time frames and the way I use fractal regression lines to gain insight on what's happening on the higher time frames, so I don't have to flip back and forth between charts. That's a key timing technique. Under the will, some things you can do. Pay attention to your fitness and your cardio so that you don't drain yourself of nervous energy. Cultivate that zero state to reduce the emotional drain and to rebuild some of your emotional bank account. The use of visualization and meditation techniques can help you add to that account. Think about your emotional bank account in terms of debits and credits. Who's writing checks on your emotional bank account? Why are you paying that bill? Unsubscribe from those things that are draining your emotions. And then look to the things that are your sources of power and emotional support, so you can preemptively build up a buffer. Gratitude and forgiveness are big for me in that sense. Diet, oxygenation, social energy, and a sense of duty are all things that I look at in order to maintain my emotional bank account. I'm really happy with the keto diet. I've dropped 63 pounds and kept it off for a year, and never felt better. Energy levels off the chart. I'm doing that nitric oxide loading 3 times a day. It's a short series of 4 exercises, 3 sets in each bundle, and I do that 3 times a day. And what it does is it generates a release of nitrogen into your bloodstream, sort of like a fight or flight response. It really energizes you, and I'll post a link to that. I'm really pleased with it. It's a form of high intensity interval training. And then for me, The social energy, such as it is, of talking with friends and some of my professional colleagues is certainly helpful. And then the sense of duty is the other thing, that it's not always peaches and cream, but that one of the things that keeps me going is that I bind myself to a duty to others, because that's my number one value. And so I know that, and that's one of the ways that I can find the will to do things when I'm tired, is I'm accustomed to doing my duty, especially when I'm tired. Patterns. Just remember the important distinction between systems and strategies. We looked at some system setups today, like the channeling and the 5-day down, and we've seen the 551W. Those are strictly defined, pseudo-coded, robotically tradable patterns that fire yes or no. Strategies are those more relaxed approaches to finding narratives and a little more discretion. I still believe I put a strong scaffolding and a framework of discipline and standardization around them to interpret, but it's a little more relaxed. Chain trading is one way to start linking those different patterns and strategies together on the symbols that you like, so you can tell a continuing story. Once you've invested in it, you can maintain the value of that information because it provides you additional context. The power of that VWAP intraday, somebody asked me a question on that earlier in the chat room or an email, that the intraday volume weighted average price is the long-term value that in the long term that the professionals have to settle up to. So the intraday moves are kind of like, oh, it's a runaway this or a runaway that. But at the end of the day, it's just another day. And like we said yesterday, tomorrow's a new day. That intraday VWAP sort of documents where things are and how things are going. We talked about that a little bit yesterday with how DIA's VWAP was bouncing around too. So that becomes a very strong magnet, especially in the afternoon, once guys start unwinding their leverage positions. The other patterns are you just got to really understand sideways quiet channel. Don't be mucking around inside there. Let that become a Z3P, compressed and exceptionally squeezed, and then play the breakout. So don't fiddle around in Crocodile River. Let the sleeping dragon sleep. When he wakes up and starts charging, then he's hungry, and then watch out. And then kind of the other end of that scale is the owl. The owl happens only after you've seen an unambiguous move, and then there was a P1 to end that move, and quite often that starts off in an SQC, and then that move terminates with a P1. That P1 tells you what the dimensions of that long first leg are. That long first leg tells you, hey, this was a directional move. Either the bulls or the bears won, so there's emotional commitment into that trade. That's what the unambiguous move means. The P1 helps you mark off the size of the move. That's how strong the traders were by the time they ran out of gas. So the retracement is going to be that big, or half of it. And if it just resumes the original trend, the second leg will be as big as the first one. So understand the two conceptual differences between the SQC and the owl, but also how they are connected, in that the SQC is almost a precondition of the owl, that you needed to have an SQC at some point in order for there to really be then an unambiguous move. And the P1 is that boundary condition in between. Like, it can't be an owl until it must pass through that P1 gate. Then you can look at that pattern of the RLXD as a way to refine the owl entry or the collapsing dragon. That RLXD now becomes your friend when you zoom in closely. So remember, the RLXD is not a reason to get in. It's simply how we get in, or the specific tactical choice of where to get in. But it must be supported by the larger context of price action over that previous 30 or 40 bars, which is what generated the SQC, the owl, the collapsing dragon. So the RLXD is simply the final trigger. It's not the end all in itself. It's just the specific moment of timing but it's not the whole song. So if you understand those 4 little concepts in there on the patterns, you are well served. The collapsing dragon and emerging dragon are simply derivatives of that. I'm going to talk a little bit more about money management, but understand the difference between the execution stop and the position sizing stop. Go through your notes, listen to the videos. That's a really important lesson for long term, because that's going to help you also with understanding the difference between markets money and your money. And then also the idea of standardized risk when it comes to money, so that the risk I take on any given trade is the same as the risk I take on any other trade. That's one of the ways that you can normalize your diet of risk, and that you're not getting spiky, attention-seeking decisions. It's always a unit of risk. You're playing poker at a certain table. You're going to play 1,000 hands, and you're going to capture the expectancy. That's what a professional does. No individual hand matters that much until you're all in, and it's because you have the nuts and you've got the mathematical advantage. So the bottom half, I want to talk about an entry refinement with the minimum manageable risk box. Okay. So one of the things that we talked about last week was how you get to the whole idea of the minimum manageable risk box. And it started off with that we defined the frog box mathematically as the standard deviation of the last 30 days of range. And we treat that intraday as the difference between signal and noise. That's frog box 1.0. We built the first generation of frog signals and strategies and systems on how to trade that. And those are pretty good. We refined that after we studied a couple thousand frog trades, and we realized that the hybrid frog gave us leveraged advantage, because it took advantage of the strength of the frog, but it got us in a little bit earlier, which allowed us to get to no lose plus dinner for 2 a little bit sooner, which let us get our risk out of that trade a little faster. And it let us get to an average trade a little sooner, and then increase the size of our average trade. So we started to get paid by shaving down the size of that manageable risk box. So the frog box is managed. We're not going to take more than a 1 frog box loss on any intraday trade. That's why I like to use the frog box as my standard position sizing risk. The hybrid frog is, we've shaved it down a little bit. I get in a little faster. And then we said, now what you're really doing is you want to move to the state of mind where you can identify the minimum manageable risk box, so that you have the smallest amount of risk per share between your entry and your signal to exit, so that once it starts moving out for you, maybe to a hybrid frog and then a frog box, we'd have been happy for a long while, and still are, if we could get long by the time it's a frog box off the low. So if this was the price and bottomed out here, and then off the low, we just stack a frog box. And if there's no other reason to get in, you can get in at a frog box off the low. If there's enough room left and time left in the day, you can get in after a frog box off the turning point, like an intermediate low. On swing trading, you could substitute an ATR for that. Same concept, different unit of measure. So the refinement in this concept is that once you've seen that low and it's moved that distance off the bottom, you can get in here. And then if price goes below that, that's your trigger to get out, because now the hypothesis has been disproven that you've seen a price that kicks you out of the trade. So now here's the next refinement. This is a refinement just on the size of the manageable risk. As long as I'm not taking more than a 1-hour loss based on execution, then I'm good to go. That means I can actually manage that risk. Now let's just add a simple thing in here like the dragon. So we had some kind of move down, whether that was a it closed here and then gapped down and sold off. That would make this a big unambiguous move. Or maybe this is sometime during the day. But then the RL10 and the price put in a observable bottom. The slope changed and it's now up. And then you get like an RLXD. So just imagine that if you could enter at the RLXD and you had some box like this that was your minimum manageable risk box, you could actually get in at the RLXD, use the manageable risk box as your 1.0 execution risk, but then still go ahead and trigger if you lost this point. If it goes below the belly of the RL10, you're going to get out anyway. You don't even have to wait for the full minimum manageable risk box to get out. That's just protecting you against a 1R execution loss. So when you add another degree of freedom, another piece of trivia onto the chart, the reason to do that is because it allows you to fine-tune that entry at the RLXD. Now, the reason to get in here is not just because it was an RLXD. That's the timing. The reason that's a good entry is because of the previous 30 or 40 bars that meant that this was an unambiguous move and an important turning point. And now the RLXD taken inside the context of that move is what makes that good. Well, you could also say if the hump of the dragon was somewhere up in here, and then this was where the yellow dot is like the call that the emerging dragon. So everything between the RLXD and the emerging dragon would be a pocket entry. So if you stacked, your frog boxes and hybrid frog boxes in there, you might be able to find ways to start entering in the pocket instead of waiting for the emerging dragon to kick in, which is quite often the place where it fails. Because that's the last time that it rolled over. It rolled over here and became this move. And now you're waiting to get in up in that. Now, if it breaks through and beyond, off it goes, and it's going to be great. But I'm coaching you to look to make these entries when the context support it at the RLXD, and then use this idea to say, where can I put my minimum management? This is one of the ways that you can actually reduce your minimum manageable risk box. You might think it's 50 cents because that was your experience from over here. But once you start entering here instead of here, you may realize, hey, I can actually use 50 cents as my execution risk initially, but then if it falls 30 cents and it hits here, I get out and I'm not taking a greater loss. I actually now discovered that my minimum manageable risk box was 30 cents. And I could have either a larger position size or trade the same position size with less risk simply by adding that refinement. So that's an important lesson on entry refinement by using the MMRB, and then also by combining it with a tactical chart pattern, which is why I want you to understand these patterns and how they fit together. Those turning points are crucial. The longer you wait, you feel like you're getting certainty. You're just making it harder and harder to get less and less of the move. So we want to find that sweet spot of acceptable levels of reliability, but early enough entries to maximize return. Here's another example. Now, I call this entering on the button. So suppose that you had a Z3 pinch or a super pincher. So a Z3 pinch would occur is if you had drawn a frog box intraday, and for 10 bars, the RL 1030 and the river were sideways, and that will lead to a compression of volatility. So now it becomes a Z3 pinch when the Z3 Bollinger Band lines both come inside one frog box. Now I have a Z3 pinch. They have pinched inside a frog box. Whenever you see that, mathematically, you're going to have a sideways quiet channel. Well, what if that stays so sideways and so quiet that not only is the Z3 pinch happening, but now the RL10, 30, 90, and 270 have all come inside that frog box. And now everything is clustered in here. You can't even see the river because it's so busy. That's what constitutes a super pinch. The Z3 lines and all four regression lines are all inside this tight box. Now, the standard way to play this is a breakout from a super pinch. So that means I would just put as these Z3 lines pinch and pinch and pinch, I draw my mechanical entry. If it breaks out of the Z3, I'm long and then I use the width of the Z3 to Z3 as my manageable trailing stop, my MMRB. So I get long and I just trail the stop from the far side. Now, if it starts failing in 3 to 5 bars, scratch it when it comes back to 0. Scratch it. But if it hasn't failed in 3 to 5 bars, then chances are this thing's going to go well. And then your job is to leap your stop, accelerate it to no lose plus dinner for 2, and lock in that little win. And you'll never lose money on that trade. So that's how you manage that one. Now I want to show what I call buying it on the button. And by the way, this is symmetrical. So if this thing was mucking around in here and then fell out, you would get short and trail it with this box. And as soon as you could, you would jump that to no lose plus dinner for 2. But one of the things that I notice is that a lot of times you get this bouncing ball just mucking around here at lunchtime. And if I see like 2 or 3 times it's held support here, I like to buy it right here and play for the far side of the channel. Now that might be the time that it breaks out, and if it does, I'm already long here, and I'm holding a price which I'm happy to have started to get long, and now at the time that it gets long, I can actually move my stop above my entry, and I can get to no lose plus dinner for 2 on the breakout. And then the same thing. If it fails quickly, a scratch. Now instead of a scratch, I actually win from here to here, and now I can get short going to the other side. And then this fake 1, go 2 often happens. That when you have this Z3 pinch or super pinch, it breaks out in one way. A lot of times it'll go and then you're happy, but then another 50% of the time it'll fail. So you scratch and reverse, and then this becomes the big move. So which way is it going to go? I don't really have a preference, but if the move prior to here was a really strong directional move, and if the swing trade pattern is favoring one side or the other, you might take that into consideration to decide which way you want to go on the button. But even if you just bought it long right here and it fails, you're only taking instead of waiting here and then cash it, your risk is even further cut in half. So that's what I mean by entering on the button. Here's an example of buying on the button. In this case, I'm short on the button. And so here was a case where whatever this symbol was, I think it was DIA. And it had pinched and pinched, and you can see all of the regression lines were coming in here. This was even still a frog box. So this is a Z3 pinch for sure. This red dot is where it broke out of the Z3 pinch, so you could get short here. Where I actually got short was the first yellow dot, because the whole day was down, and the PSAR had rolled over, and the dragon was rolling over, and it broke through this little PSAR, and now it was this way. So I just got short here and said, now by the time it broke out at the red dot, I could make that no lose plus dinner for 2. So I was basically front running the crossing of the VWAP. So a lot of times it's not a difference that makes a big difference. And I normally tell you don't screw around inside the Crocodile River. But when it's just a tiny little stream, if I like it here, I love it here. What's the difference? It's a fractional loss anyway. And now by the time it had made 2 moves, by that second bar, I was able to move my stop and then lock in no lose plus dinner for 2, and I made a nice move. So it's the difference of getting from 21.14 to 21.08. That's only 6 cents, whereas 21.22 that was 20 cents. So I was already much deeper in the money. So that's what I mean by buy it on the button, and then I don't have to wait for the breakout and then get a bad fill. Last 2. Hang in there. You guys are doing great. Larger scale, I want you to think about your job. You're making bricks, and the raw materials to make bricks, you need symbols that have a lot of volume, enough volatility to get those moves, and enough buying interest so that the spread is small and it's always in play. That's the Dow. For me, that's the Dow 30, ETF 30, and some of those specials. Now, the relationship now between your swing and your intraday, I start with the swing trades because I want to know where the market is and the sectors and where we are in the life cycle. And so those swing signals you see me looking for, I'm looking for the mechanical signals, those strategies, and then any continuations from today. All of those things go into making good target qualities. And then when you add market conditions, the market condition may be very favorable for a swing too. Like if the market is in a swing trade condition or at a critical state, a good market for swing trading plus high quality swings are the raw materials for making good bricks intraday. But they're also the raw material to make a very good swing trade. So when the swing trade fires according to the trade frame based on norms and templates and processes, that thing is in vogue for 5 or 10 days. And then that's the core position. And as long as that signal is still open and valid, I may be able to offload this and do a little bit of turbo intraday and then cash it and then stay with the core and then turbo some more and then turbo some more until that swing trade is over. And I'm all the way through there. I'm thinking about the target, the sector, the market to try to see how much juice is left in that squeeze. And then some of those are related to core positions I'm holding. But the money that is earned from here, these are like the core swing positions that are reinforcing the core portfolio. That's the central idea of hybrid trading. It's really mastering the swing time frame. That's why I spend the time every day on that portfolio speed run, because there's a lot of ideas in there for any of these individual symbols. By the same token, the intraday trade itself is its own thing with its own structure for trade framing norms. And sometimes I can just get a peak for no swing reason at all, but just the intraday move was so strong, like U.S. Steel yesterday and 2 days ago, that it just makes intraday moves a couple in a row, and that series of turbo trades could grow into being a swing trade simply because the market voted that way with 3 days in a row. And then lo and behold, that's a momentum play in that direction, and now it's a swing trade. And then it joins the family of swing trades, and that becomes one of those continuation swing patterns that can just continue to grow and go. And then finally, the ideas of markets money. So I think of my money in 3 buckets: day money, swing money, and long-term position money. Right now, I got about 20% of my money in the core. That's at blended monthly rebalancing and annual asset allocation. Swing trades has about 40% of my money, and 40% of my money is on day. Now, most of my money's not in the market on the swing trades because bear normal. And it's at a critical state, and it's not really favored for swing trading yet. So the only swing trades that I'm holding are ones where I have earned markets money from the day trade out of my little 4 bullets. That's where so 40%, 40%, 20%. So my day trading is generating cash, and then that's funding things that become swing trades. I'm using earned money to fund those positions. So my span of control maximum intraday at one time is four separate trades or 4 bullets in one trade. Swing trades, I'm typically going to have 5 to 20 positions. I don't have that many right now, but this isn't normal. So normally up to 20 positions if things are working right. The core positions are just funded and fully invested all the time, whatever that looks like. I try to get 5. The swing trades, I'm going to come back to for a second, but the day trades tend to be their own thing, and I'm cash at the end of the day on those. The swing trades, as I'm looking at the composition of those of the portfolio, I try to be a little diversified in time. And so if the market is doing some kind of move like this, or if that's the business cycle of a trade, I like to have some that I'm just entering, some that are starting to work, some that are working well, and some that I'm harvesting. So there's always some coming off that go back into the pool, and some coming on, and then some that are in different stages of life cycle. So it's like I'm doing inventory rotation. They're not all being started at the same time, and they're all not finishing at the same time. Hopefully I've got things that are in different stages of their life cycle. The other way I can diversify that is try to find some things where the swing is taking them, they specialize in being long, or maybe some that are specializing in being short because they're weak, or some that are can go kind of either way with band trading. So I try not to have overly correlated positions by diversifying them in terms of when I enter. So I'm always adding some and then harvesting some and managing the ones in the middle. Or I'm trying to find different ideas to go in different directions so that what I don't want to have is 20 positions that are really just the same position, right? Finally, one of the things that I can use the swing trades for is to protect against sudden downturns in those long-term core positions. What I really want to do is just buy and hold those forever, and then use those monthly adjustment rules to, when it pulls back, to get it onto the next one. So you get these long periods of gain and maybe some sharp sell-offs. When I find the market's in a critical state or want to get market neutral, I can use a leveraged swing trade to make that thing market neutral overnight, or I might even do that with a day trade. And then with leverage, I can do that so that my long-term positions, they can just leave them alone. So I always know what that posture is, and then if I need to hedge it, I can use one of these 2 buckets to do that. So my goal is to really just manage it. The final thing I want to talk about in money management is the idea of the difference between professional money and then money that's up there being risked in irrational exuberance, like beyond the 2-hour battle drill or beyond the Z3 or beyond the range stat or in a parabolic move. I know the market can stay crazier longer than I expect, but what I don't want to do is be framing my trades professionally between -1 and +2R, and protect my seed corn and risk it, and then try to reduce my open risk and get to no lose plus dinner for 2, and then use markets money to fund these newer positions, and then have this thing go off into the land of irrational exuberance and then get caught up in the emotion, and then lose money that I earned on this side of the fence simply because I adopted a belief that maybe this is going to be the one. So I try to accept gifts, but I don't believe in them, and I see a real difference in the money that is earned from capitalizing on irrational exuberance versus money that I earned in the professional way. So the way I do that is that those gains that are bigger than 2R that come from that irrational exuberance, like a parabolic, I just treat that as found money. I count it as a 2R win, and I don't think that that was normal, and I don't think it's because I was smart. I just realize it's because I was lucky, and I don't want it to distort the decisions that I make down here in the place where I'm being professional and using architecture and norms and framing. And I keep this geometry the same. I don't let the results of irrational exuberance upset my apple cart. What's that mean? Well, it means that I don't grow the account maybe as big as I might under some conditions, but I don't care. I don't want to jeopardize my professional money management because the market happened to be. I'm not going to let the market be my excuse for why my rules got too loose. So I'm very strict on my risk management and money management. And so those are just some thoughts about managing portfolio risk and position risk and how I use those three different buckets of money and whatnot. Okay. So that's everything I wanted to cover tonight. I'll get this processed and hung. I'm glad we could get the speed run done. Daily charts are already out there. You got some work to do. Keep working through your swing and intraday combos there. Start looking at how you might reinforce one with the other. Keep working your SPCE if you're interested in that swing trade. Otherwise, I think Mexico, Brazil, DIA, even US Steel are worthy of your attention right now. Okay? And treasuries. We looked at treasuries too. I think that's going to be a good one. That has the advantage of not being very volatile on the swing. So take good care, guys. Keep up the fire. Keep your risk measured and your powder dry.